In this episode, we're going to talk about tax consequences for syndications that oftentimes get forgotten. Stick around. Let's go! John VanDuzer, my man, thanks for being on the show. John is with James Moore and Company. They're one of the top CPAs really in the country, but they're largely known in the Southeast. I know a bunch of top investors that use them. I've certainly sent them a bunch of business. And John and I were having lunch recently, and we were talking about all kinds of topics. And John, I know you've seen, because I've heard of this, and I'm sure you've heard of this, folks that have gotten into some tax trouble where a syndication may have sold an asset, distributed, money to some of their investors, and then get hit with a big tax bill. Or sometimes it's in the reverse, where the investor who invested in syndication got their money from a syndication and they were later called upon for taxes. And so I thought, man, we should do a video on this and just get some clarification from you, some things that folks can do to both kind of look out for this and how to avoid very, very bad situations. John, thanks for coming on, man.
Yeah, Beau. Hey, thank you for having me. I really appreciate, the chance to talk to you, and I always enjoy catching up. And so as we were discussing, this is one of those areas that was kind of piqued my interest, especially as I was thinking about how the people that you deal with on a daily basis, this is probably one of the more relevant topics to them when it comes to taxes. I always think about a syndicator as a more tax neutral, right? Like if it's somebody else's money, it's like, well, if I can minimize taxes, great, but I may not be tax motivated. But this is kind of a sticky compliance area where I think it can cause a lot of headaches. And so it really needs to be paid attention to. Kind of what you were talking about is in certain circumstances, a partnership for tax purposes could have to be required to basically withhold taxes on behalf of the partners. So generally all the partnerships are flow through entities. They don't pay taxes directly, but under certain circumstances, there are withholding requirements. The two biggest ones that come to my mind are one, for state income taxes. And then two, there's actually a federal withholding requirement if you have non-US resident partners. If you basically have a partner and they live in France and they're a French resident and not a US resident, then you actually have to withhold taxes on the partnership's income on their behalf.
When you say partner, you're also speaking of actual investors in the syndication as well.
Correct. Yeah. That's investors in the syndication, right? Whether it's an entity or a person or, something like that. It's an investor and there's certain circumstances where that withholding would be required. And there's very specific rules. So that's the other thing is it's not as easy as saying, oh yeah, 100% of the time, this is the way it is. Right. What happens there, you and I live in Florida. Florida doesn't have an individual income tax. So a syndication deal in Florida where all of your investors are individuals, it's a fairly uncomplicated deal from a state income tax perspective because there are no state income taxes in Florida. But other states have those income taxes, and that's where the rules get varied because there's basically 50 different states and there's 50 different sets of rules. So what I've seen and what you alluded to is, say you buy an asset, say in Illinois, and you hold on to it for 3 years. And during those 3 years, you're able to claim depreciation and you're working on stabilizing the leases. And for tax purposes, your CPA performs magic and you don't have any income on the asset. And at the end of 3 years, you sell it and you make buku dollars and you provide your investors with a great return and everybody's happy. But this is the spot where you may end up with a tax withholding obligation. So like we've said, I've seen where somebody who wasn't really aware of those rules and it didn't come up all 3 years that it's been in existence because there's been losses and there's no income tax withholdings on losses. Now, all of a sudden, there's big dollars of income. There's big withholdings that are due at the state income tax rates, but they goofed and dispersed all of the proceeds around the time of sale, right? So, yeah. I've lived it, right? And I've been there with investors now that are getting a call. Say you sold the asset in September, dispersed all the funds, everybody's happy, they got a good return. And then your accountant calls you in March and says, hey, here's where you need to remit the withholding taxes for Illinois. And you're like, great, I don't have the cash in the entity to do that because I dispersed it all. So then you're having to call your investors and say, hey, by the way, I need you to send me back a check, and then we're going to send that to the state, and then we're going to give you a K-1, or you can claim the withholding on the K-1 and then get a refund from the state. So it becomes this big, painful mess that irritates everybody.
Yeah, it's like you were the champion of the world and you got them a great IRR and the hold went just as planned and you've dispersed it and they've been able to talk about, to their friends about, hey, this indicator was fantastic. You should join with us in the next project. And then all of a sudden you get the phone call and you're like, yeah, we need to check back. Oh, it's the worst. And it's embarrassing. It's got to be embarrassing for the syndicator part too.
For sure. I mean,
and I'm sure it's happened in reverse. I mean, what about like in the reverse on the investor side? Sometimes that's happened in the reverse, right?
Yeah, no, I've seen it. And then, there's frustration. And then you also, from the syndicator side, you're like, well, what if they say no? What if they say I already spent the cash or the cash is already invested in the next deal? Like, it creates a whole headache of issues. As time has gone on and the world's got a lot smaller, I feel like this has become a bigger problem, right? Maybe 10, 15 years ago, you probably didn't have near the level of syndication kind of at all sizes that you have today.
Right.
And you may not have as much investment across the country as you do today, where, this is becoming more and more prevalent of an issue. I think the states have also buckled down and realized that this is a source of revenue. From a state perspective, they'd always rather tax non-residents more than residents, right? Because you got to think about who's voting. So this is an area that's increasingly challenging. I know one of the ways our firm has dealt with this is we actually have people dedicated to, we call it SALT, state and local taxes, but the rules got so complicated that we basically are like, we need somebody just dedicated to understanding all these rules. By state, there's different income tax rates, there's different income tax rules, some states you can actually elect out of withholding as a non-resident. And basically what you do is fill out a form that says you pinky promise to file in the state and pay your taxes, and they'll let you elect out. Some states you can file what's called a composite filing, where basically the partnership itself can file on behalf of all the investors and pay the tax so they don't have to. And, there's also, this is just income taxes. There's state tax filing requirements. Like in Florida, for instance, a commercial lease has a requirement for sales tax. Well, if you're an out-of-state person, you may not know that unless somebody tells you or you specifically know to go look into that. It's one of the unusual quirks of Florida. On the multifamily side in Florida, leases less than a year are also subject to sales tax because they're treating you more under kind of the hotel rules than the residential rental rules. So if you have an apartment complex asset and you're doing 6-month leases for whatever reason, you could have a huge kind of bed tax, sales tax, all these other filing requirements for the state. And if you don't know that, they can rack up really quick. And so it's one of those headaches that you see. And there's, again, 50 different rules all across the country. And when you factor in different cities have different rules. So in certain, like New York City has city income tax in addition to state income tax, in addition to federal income tax. So a whole lot of rules. So that's an area that we've had a lot of focus on, just making sure that we can cover all of our bases.
So I've been told on the income part of apartment rentals under 12 months, if it's a resident who's already living there, let's say they did a 1-year lease, and the renewal's coming up and they want to renew for 6 or 7 months, I've been hearing that property managers will simply just do an extension of the existing lease in order to avoid the sales tax.
That's right. Yeah. Because you can kind of finagle your way around it. Right. And I think, again, this is where I always tap on our SALT folks to be like, hey, help me navigate through this. Is it an original term less than a year? Is it any lease term less than a year? Do you do an extension addendum instead of a new lease altogether? And the list goes on and on. But you're right. It can get very sticky on, you want to dot all the I's and cross all the T's, because ultimately that's going to help drive that IRR at the end.
And I would imagine, this is kind of a plug for you guys, is if someone is as big and well known as James Moore has a dedicated team for something like this, there's probably a good number of just sort of small and average size CPA companies that may not know this stuff at all. What do you Google or what do you look for? How do you determine whether or not a CPA knows this kind of stuff besides just going down the phone book and calling? Or you're just asking around, I guess.
Yeah, I think it definitely probably takes a certain size to be able to sustain that. Like I said, we have a person on staff full-time dedicated to that. And that's a more recent addition on our staff. So as our firm has grown in size, it takes these issues kind of hitting us across the head in order to say, hey, this is a big risk area and we need to deal with it. I would say there's a lot of good CPAs out there that are even small that handle it and do a good job. But I definitely, as I've worked with new client and following their prior accountant's work, I've definitely seen some that, their accountant was in over their head a little bit. And it's generated issues related to just notices. And in one case, there was notices that the syndicator is not the one getting the notices, it's all the investors. And so the investors are saying, hey, I'm getting a notice related to your investment. What gives, syndicator? And I'm also having to pay my accountant to sort out this. So, I'm gonna forward that bill to you. It can create a big headache there too. That's something we've seen as well. I'm just cheery, all rainbows and Skittles today with state taxes.
This is super important stuff. I mean, if anything, it's avoiding what was otherwise a glorious, event to be able to distribute income, and you take all that in an instance, you can lose your reputation, your name, and it's tough to get those same investors and invest with you again. Awesome. Well, thank you so much for passing this stuff along. And I will be sure to put how you can reach John and his firm down in the description below. Obviously, if your CPA is knowledgeable about this already, stick with them. If you think you're not getting the best guidance, reach out to John. If he can't help you, he'll make sure to point you in the right direction.
Thank you, Beau.
So thanks, John, very much for being on the show, brother. And we'll be sure to hook up again in the future.